I remember the exact moment I saw my full mortgage amortization schedule for the first time. After years of making every payment on time, the balance on my loan had barely moved at all. It felt like I was being robbed by the bank. The numbers felt disrespectful, almost insulting. That night, I realized something painful, something most people don't discover until it's too late. Mortgages aren't created to help you own a home. They're created to keep you paying as long as possible. Level 1. The trap you don't see coming. I sat there staring at the numbers and it finally hit me. This wasn't a mistake. It was the design. Mortgages aren't written to help normal people build equity. They're structured so the bank gets paid first, most, and fastest. And here's the part that hit me hardest. Even though I'd been doing everything right, I was still losing, and losing quietly. And the banks know this. They depend on it. That's why they're quietly rolling out 50-year mortgages that turn a simple $400,000 home into more than $1 million in total payments. It feels affordable because the monthly number is lower, but the total cost becomes enormous. Later in this video, I'm going to reveal the exact psychological trap inside your mortgage contract that decides whether you'll escape debt or quietly drown in it. If you miss that part, and you'll miss the single shift that could transform your financial life. If the system is fair, why does it benefit everyone but the homeowner? Level 2. Why mortgages are built to win against you. Across America, people feel financially squeezed, and lenders know it. So they package longer mortgages as solutions. Lower monthly payment, smaller barrier to entry, a friendlier number on paper. But this works because of payment bias. A mental shortcut where your brain fixates on the monthly cost and completely ignores the lifetime cost hiding behind it. Show someone a $2,500 payment, and they'll say, "I can handle that." Show them that the same home will cost over $1.5 million over 30 to 50 years, and suddenly it doesn't feel affordable anymore. But banks don't lead with total cost. They lead with comfort. Because comfort closes loans, and comfort keeps people from asking dangerous questions like, "What does this really cost me?" A 28-year-old once told me he was excited to be approved. But when I showed him the payoff timeline, he looked at me and whispered, "I'll be 78 when I'm done paying?" His excitement drained in seconds. The realization hit him like a punch. He wasn't gaining a home. He was inheriting a lifelong bill. If comfort blinds us, what else are we missing inside the paperwork? Level 3. The math that should make you furious. Let's break down what really happens. Take a $400,000 home. A 30-year mortgage comes out to around $2,530 a month. You'll pay roughly $510,000 in interest. Total cost, about $910,000. A 50-year mortgage lowers your payment to $1,976, but stretches interest into something monstrous. You'll pay around $785,000 in interest. Total cost, more than $1,180,000. That's nearly $275,000 extra, paid quietly over decades, disguised by a lower monthly payment. But here's what makes it worse. After 10 full years of a 50-year mortgage, you've built only 8% equity. 10 years of work, and 92% of your home is still owned by the bank. It's ownership in name only. And here's the twist almost nobody thinks about. The $554 monthly difference between a 30-year and a 50-year mortgage? If invested at just 8% annually, it grows into more than $403,000 in 30 years. Most people never realize they're choosing decades of debt over hundreds of thousands in potential wealth. If the math exposes the truth, what happens when we include all the hidden costs? Level 4. The hidden costs that turn a mortgage into a money pit. A mortgage payment is only one piece. Property taxes rise almost every year. Insurance rises, sometimes sharply, depending on your state. Maintenance rises. Roofs, HVAC units, plumbing, flooring. Everything ages. Everything costs money. A home is stable emotionally, but financially, it behaves like a slow leak that widens with time. That affordable $1,976 mortgage quietly becomes a true cost closer to $3,000 per month and climbing, especially as inflation pushes every related expense upward. If the affordable option becomes the expensive one, is it really affordable at all? Question of the day. Would you rather end your life with a house or with $8.4 million growing for your family? Comments below. Level 5. The renter who ends up richer. Most people never realize that renting, when paired with disciplined investing, can build far more wealth than buying with a long mortgage. If someone rents for $1,800 and invests the difference between that and the 50-year payment, plus invest their would-be down payment, the math explodes upward. At a modest 10% return, that grows into $1.87 million in 30 years, and $8.4 million in 50. This isn't about being anti-homeownership, it's about being pro-math. Because the numbers paint a very different story than the one most people grow up believing. What if the smartest path wasn't ownership first, but investing first? Level 6. The smarter path. If you still want to own. Homeownership is emotional. I get it. But you can still own a home without surrendering 5 decades to the bank. A 15-year mortgage costs more monthly, but it slashes interest by more than $558,000. And you're free decades earlier. Imagine owning your home outright by your 40s. Imagine waking up one morning and realizing the biggest bill of your life is gone. Imagine having the freedom to change careers, start a business, travel, or simply breathe easier. That changes everything. Your stress level, your retirement, your opportunities. If freedom were available sooner, would you take it? Level 7. The hybrid wealth strategy most people ignore. Here's the strategy I recommend for most people. Rent affordably for 5 to 7 years. Invest aggressively. Build a 30 to 40% down payment. Buy with a 15-year mortgage. Continue investing the difference. And here's why this works so powerfully. During those first 5 to 7 years, your investments have time to grow while your expenses stay controlled. Instead of draining your budget with repairs, taxes, and interest, your money compounds untouched. By the time you buy, you're entering homeownership from a position of strength, not desperation. You're leveraging time, discipline, and math. 3 forces the average buyer never uses in their favor. This approach creates equity, stability, and real long-term wealth. What would your life look like if you owned your home and built wealth at the same time? Level 8. The 2 futures you must choose between. Picture 2 28-year-olds. One chooses a 50-year mortgage and ends life with one house. The other rents, invests, buys smart, and ends life with $8.4 million and a paid-off home. A legacy that changes their family forever. Now that you know this, mortgages are structured to keep you paying far longer than you realize. You're going to need to know this. How to break the cycle and build wealth faster than your debts grow. If you don't know this, you'll spend decades making the bank rich instead of your family. The secret is in my next video. You don't want to miss it. See you in our next video.